Hello and welcome to Portfolio Matters, weekly markets checklist, week 161. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. Okay, before we get going, a couple of housekeeping items. First of all, reminder, pub night is Monday, the 24th of June. Richard is away sailing with his children this week, so I'm afraid you've just got me. And next week, there will be no Portfolio Matters as I am away in Croatia. Normal service resumes the week after. And thank you to Rogue Trader for his hard work in putting together the Discord chat this week. We didn't manage to get through the whole of his presentation on money, so we will be doing another one in July. Okay, news. So it was an eventful week, actually. We had the JOLT job openings data in the US on Tuesday, and that showed a sharp drop to 8.06 million job openings in April, down from 8.49 in March. That's before March number was and the March number was revised down subsequently. That portrayed a US jobs market which was slowing, leading to a rally in treasuries as interest rate expectations fell. So expectations Fed rate cuts increased. Equities also rallied, and Nvidia's market cap passed 3 trillion. The ECB cut by 25 basis points yesterday, 3.75%. The Bank of Canada cut by 25 basis points to 4.75%. Central banks have started their cutting cycle. OPEC Plus met last weekend and agreed to extend the current cuts until September, but then they will begin to unwind the 2.2 million barrels of voluntary cuts. Goldman Sachs estimate that OPEC sits on 6.5 million barrels of spare capacity. So more oil is coming onto the market later this year. The oil price dropped. And finally, Minneapolis Fed Chairman Neil Kashkari gave a speech this week in which he said US interest rates should stay higher for longer, even at the expense of economic growth, to get inflation back under control. So some charts relating to the news. Well, this is the Eurozone interest rate, and it has been cut by 25 bips to 3.75%. But at the same time, the ECB raised its 2024 inflation forecast to 2.8% from 2.6% previously, and its 2025 forecast to 2.1% from 2.0%. It also raised its growth forecast for 2024 to 0.9% from previously 0.6%, and reduced its 2025 forecast. So, although the ECB cut, which was very well flagged and expected by the market, the rate of future cuts remains uncertain and will depend on further progress with inflation. The Bank of Canada also cut by 25 basis points to 4.75%. And the Fed meets later this month. It is not expected to cut. And as the Fed's preferred inflation measure, that's called PCE inflation, continues to fall, so US real interest rates are rising. And we had the JOLTS data this week. We'll take you through it. After the JOLTS data came out, the market priced in faster Fed rate cuts. So the first Fed rate cut is now priced in for November. So the Fed is absolutely not expected to cut rates in June or July. And Bloomberg have fed recent Fed speeches into AI and to determine whether the Fed is more hawkish or more dovish. And the Fed has been increasingly hawkish in recent weeks. Now, after Donald Trump's conviction in his hush money trial last week, the odds of him winning the presidential election have fallen and Biden's have improved, but he is still ahead in the polls. And turning to the UK, well, the latest projections are that Labour are going to have a total landslide, which I don't think is good for the governance of this country. And finally, on to OPEC. So the cuts they are unwinding are the light blue bars, and that adds up to 2.2 million barrels coming onto the market in the year starting September. OPEC retain a lot of spare capacity. And the bull market in equities continues. Nvidia's share price continued to go through the roof. It's beyond exponential. Its market cap has now surpassed 3 trillion. It's on a trailing PE ratio of 71 and a forward PE ratio of 46, just as its future revenue growth is forecast to start slowing. It has a market cap of 100 million per employee. Okay, and on to this week's economic data. The UK is puzzling. The GDP numbers are positive, it's growing, but it also appears to be losing jobs. And the forecast data for April, which we'll get this month, are very poor. The market is anticipating the UK losing a lot of jobs, which seems incompatible with rising output. In the EU, the economy is weak, but shows clear signs of strengthening. In the US, the economy remains strong, but there are clear signs that the rate of growth is slowing. China, difficult to tell. The latest Caixin PMIs contradict the NBS PMIs, which were out last week, showing the Chinese economy doing just fine. The global economy seems to be okay. Okay, on to the UK. So we had nationwide house prices month on month. These are the average house price on which Nationwide writes mortgages, and they rose by 0.4% in May, breaking a trend of a couple of months of falling prices. Year on year, they rose 1.3%, matching expectations. Mortgage approvals are actually okay, amazingly, pretty much unchanged on last month. Mortgage lending was much stronger than expected, so that implies that UK mortgage owners have not been paying down their mortgages as much as in previous months. Consumer credit was poor, so that meant net lending to individuals was stronger than anticipated because of the strong net mortgage lending. Money supply was disappointing, growing 0.1% against expectations of 0.4%, but the money supply is growing again. British Retail Consortium's retail sales year on year was disappointing at 0.4%. April showed a shocking drop of 4.4%, and it was expected to bounce back to 1.2%, but it didn't really. So disappointing. Construction PMI, amazing, actually 54.7, and that is a good number. So UK construction activity is picking up despite high interest rates. And that has mainly been driven by increased commercial activity. Housing activity is sort of neutral at a low level, but The commercial sector, increasingly confident. The Citigroup Economic Surprise Index remains very strong for the UK, so the UK is outperforming expectations. The Indeed Job Postings Index continues to drift slowly down. Trueflation dipped down in the start of June, but remains 3.1%. Reminder, Trueflation is not seasonally adjusted, and most UK inflation occurs between February and May. And so, hopefully, we should see inflation start to drop further in the latter half of the year. Talking about UK construction, well, the number of employees in the UK construction sector has fallen quite sharply. But you've seen that the PMAs suggest that the construction sector in the UK has actually bottomed and is rising again. And construction companies are complaining about their inability to find workers. Now, I thought this was really interesting. This is from the FT and shows where UK construction workers come from. Now, frankly, I was expecting far more construction workers in the UK to have come from the EU. But as you can see, they're only a small fraction of overall construction worker employment. And the vast majority are UK born. And what this chart shows is the number of workers by their age, and a huge chunk are over 50, and they will be retiring in the coming years, and there aren't enough young workers coming through. So the UK needs to stop sending young people to do media studies courses and actually get them to be bricklayers. So, UK summary. Well, the UK housing market appears to have bottomed despite interest rates remaining high. House prices rising, construction activity has bottomed. The UK consumer, though, remains weak. And if job losses continue, that is likely to continue. So, UK economy is a puzzle. I don't understand how it's managed to grow but lose jobs while labour productivity remains rock bottom. Is it strengthening or weakening? The data in the coming weeks should reveal all. Moving on to the EU, well, we had inflation for May, and that was slightly worse than expected. CPI month on month came in at 0.2%. Against expectation 0.1%, but well down on April. That meant year on year it disappointed, rising to 2.6% from 2.4% in April, and that was above expectations. Core rose to 2.9%, up from 2.7% in April and above expectations. The ECB still cut rates, because I think they'd got themselves into a hole because they'd given so many speeches saying that they were going to cut rates. The pace at which they will cut from here is unlikely to be terribly fast unless services inflation comes under control. If you look at services inflation, it's not great. In May, it was 0.6%. Well above expectations. Now, goods inflation in the Eurozone has been steadily declining and is now 0.8% year on year. Services inflation, that has not been declining. So the ECB needs to see that coming down before it cuts rates much further. But before we get too pessimistic about EU services inflation, one of the big factors behind the rise in service inflation has been German transport ticket prices, which were subject to big discount in May 2023, and that has now fallen out of the comparison window. Factory gate prices, as measured by producer price index, fell by 1% in April, better than expectations, and down on March. So that's good news. Goods inflation is coming down. So year on year, again, beating expectations, down 5.7% year on year, although that was higher than March. Retail sales month on month in April were disappointing, down 0.5%. Much of that is weather related. Year on year, 0. Again, worse than expectations, down on March. The construction PMI picked up to 42.9. That is still a dreadful number. That missed expectations, but it was up on April. The Citigroup Surprise Index is solidly positive. So Eurozone also outperforming expectations. Job postings index from Indeed continues to fall, though it did bounce last week after a big drop the week before. And this is France, which continues to show declines. But the story of the Eurozone is a strong periphery, a weak core, because the core is much more dependent on manufacturing. If you look at Germany, that's what a proper recession looks like. That's the change in construction employment. And this is the change in manufacturing employment. Reminder, the traditional way a recession works is you lose jobs in the highly cyclical sectors of construction and manufacturing. And that leads to cascading job losses through the rest of the economy. In Germany, you absolutely have that. So the black line is the ECB's interest rate, and the yellow line is the Taylor rule. And so the ECB's latest cut means that Eurozone interest rates remain restrictive after having been ludicrously lax and stimulative for years, but only just restrictive. So EU summary. Well, Eurozone inflation disappointed in May because of persistent inflation, and in services inflation is rising. In order for the ECB to cut further, services inflation in the Eurozone needs to start falling, but services inflation should come down with wages, and wage inflation is expected to keep on falling. We expect Eurozone inflation to fall in the second half of the year. Retail sales weak, construction PMI remains very weak. The bottom line is the Eurozone economy is weak, but appears to have bottomed. Okay, on to the US, and we had a lot of data from the US this week. So first of all, JOLTs. Well, the JOLTs showed a big drop. The number for April was 8.06 million job openings, and that was down sharply from March, and the March number itself was revised down heavily. So including the revisions, there was over a 5% drop in job openings in April. The quits rate unexpectedly rose. So more US workers were feeling confident enough to leave their jobs for another one. And when we dig further into the JOLTS numbers, there are some funny things going on. So the top chart shows job openings for small businesses with less than 9 employees. And you'll see job openings there remain mystifyingly strong, whereas job openings for companies with 10 plus employees are falling and have fallen very substantially. So what's going on? That seems unlikely, given we know that the National Federation of Independent Businesses report poor small business profitability and low hiring intentions. And it also seems inconsistent with the Paychex Small Business Employment Index. Now, this is the first time we've covered this, but this is an independent measure using aggregated payroll data from businesses with fewer than 50 workers. And this offers an up-to-date measure of changes in small business employment. And it has hit the lowest level since 2014. So this chart shows the aggregate of companies with fewer workers not doing very well. It seems unlikely that small businesses 1 to 9 employees are continuing to hire. But when you look at companies with 1,000 to 5,000 employees, there was a huge drop in job openings, which seems like a bad data point to me. So, on the one hand, the very small business job openings looks too high. On the other, but the job openings for companies with 1,000 to 5,000 employees probably looks too low. It's also worth noting that JOLTs may overcount job openings because a remote working job that is listed in different cities is counted each time it's listed rather than as one job. So, depending on the number of remote working job openings, that will lead to double counting. The fall in job openings brings the job openings per unemployed worker back to its pre-pandemic level, but that remains tight. There are still around 1.2 job openings per unemployed person. Overall, the jobs market is tight but weakening. Now, the dark blue line here is the hiring rate, and that is low. So companies are not hiring very well. Actually, that's the lowest number since 2014, and they're cutting their hiring, but they're not really laying people off. The layoffs during the month fell by 86,000. That's an annualized rate. Construction job openings fell sharply in March and fell further in April. So it does look like the construction sector is finally slowing in the US. And this is the Beveridge curve. And if you're going to take away one chart this week, this is probably it. So the Beveridge curve looks at the job vacancy rate on the y-axis and the unemployment rate on the x-axis. And what it's showing is that so far the fall in job openings has not translated into a rising unemployment rate, but we are nearing the inflection point where it starts to do so. So extrapolating the current rate at which job openings are falling, the pickup in unemployment should start anytime now, but not become substantial until late Q3 or Q4. And we also had the ADP employment change numbers, and they were not great. Expectations were 175,000, came in at 152,000. So the US still creating jobs, but not as many as previously. Reminder, non-farm payrolls are out later today. And when we talk about non-farm payrolls, the blue line is manufacturing employment as reported by the BLS, Bureau of Labor Statistics, and the red line is ADP's reported manufacturing employment. And there is growing debate about the veracity of the non-farm payrolls, and analysts think it is substantially overestimating total employment in the US because of the births and deaths model. I'll cover that next and in 2 weeks' time when we talk about non-farm payrolls. Challenger job cuts were less than expected, coming in at 64,000, down on April. So US employers are offering fewer job openings, but they're not laying people off. Although job cuts are 55% above their pre-COVID average for the month of May. And the Challenger report also included data on hiring plans, and that was really poor, actually. So only 4,200 firms intended to hire, and that was 21,000 below the pre-COVID average. So further evidence that US companies are cutting back on their hiring plans. Now, last Friday, we had PCE inflation numbers, and they were good in that they met expectations. So month on month, the headline number was 0.3%, unchanged from March, in line with expectations. And so PCE year on year was 2.7%, again, unchanged and in line. Core PCE was better than expected at 0.2%, down on March and better than expectations. Year on year, it was unchanged at 2.8%. Now, if you get rid of some of the non-market inputs into PCE inflation and CPI inflation, such as owner's equivalent rent, and you look at harmonized numbers, so these are done by the BLS and the BEA, and they aim to make US inflation statistics comparable with European ones. And if you do that, core PCE and core CPI inflation are in line with the 2% target. So what is causing elevated inflation in the US is the way they measure inflation. It's not the underlying data. The San Francisco Fed breaks down inflation causes into demand-driven and supply-driven, and there's not much demand-driven inflation. So that implies monetary policy is working, and the Bank of America agrees. And we also had the ISM PMIs this week. So we had manufacturing PMI, which was disappointing, falling again. So after a brief tick up 2 months ago into positive territory, the manufacturing sector appears to be weakening again. The May number was 48.7, down on April, well below expectations. Expectations had been for it to strengthen. It didn't, it weakened. Manufacturing employment mystifyingly rose to 51.1, implying that manufacturers were starting to look at hiring again, and that contradicts the JOLT's job opening data and everything else. New orders fell sharply to 45.4, well down on expectations and well down on April. Prices paid fell. That's good news. The blue line is new orders, and the black line is inventories. And once more, inventories exceed new orders according to the ISM, and that implies new orders will fall further in the coming months. Moving on to services, and services were a big surprise because they showed a big strengthening, and that is the best number for many months. Expectations were for 50.8, and it surged to 53.8, massively above them and well up on April. And the main reason was a surge in business activity. So business activity came in at 61.2, which is an enormous number, the best number in a couple of years, well up on April. Employment, though, came in at 47.1, up on April, but still poor. So despite the surge in business activity, companies were not intending to increase employment. New orders rose to 54.1, That was better than expectations. Services prices paid fell back to 58.4, but that is still. But, and we've talked about this before, the relationship between all the various PMIs and actual activity has been very weak or non-existent. So the black line is the ISM services PMI. The green line is services output. And obviously, over the last couple of years, the US economy has been quite strong. But you really would not have known that from the services PMI. Personal income month on month came in at 0.3%, in line with expectations, down on March. Spending was weak at 0.2% month on month, down on March, and down on expectations. Construction spending fell 0.1%. For the second month in a row, US construction activity fell. But contradicting the weak ISM manufacturing PMIs, the April numbers showed factory orders continued to rise, up 0.7%, beating expectations, and that's a decent number, although the March number was revised down. Ex-transport, a good number, beating expectations, 0.7% month on month. But when you look at manufacturing orders in the US, the blue line is nominal, the green line is real. And you'll see, actually, manufacturing new orders have fallen quite substantially in real terms over the last couple of years. The manufacturing sector is in recession in the US. Total vehicle sales, though, held up well and continue to hold up. Good news, final estimate of unit labor costs for Q1 was revised down substantially from 4.9% to 4%. We also had the RCM TIPP Economic Optimism Index, which is a survey of 1,300 US consumers, and that was pretty awful, actually. In June, they were feeling more pessimistic, so expectation was for it to rise, it fell. Contradicting the ISM services PMIs, the Chicago PMI, which looks at just total business activity in the Chicago area, was terrible. So it was expected to rise to a pretty dreadful 41 in May. It actually collapsed to 35.4, and that is a really terrible number. So lots of contradictory data. The Johnson Red Book retail sales, that's still pretty decent, 5.8% year on year. 30-year mortgage rate remains high. Mortgage activity for purchases is dead, nothing going on. Initial jobless claims ticked up a bit, but that's still a pretty low number. Continuing jobless claims, is that steadily rising? It's still not particularly elevated. And when you compare it to its pre-COVID trends, so top right, continuing unemployment claims are definitely elevated and rising, but again, not particularly elevated, whereas initial jobless claims are not very elevated at all, and actually slightly below the pre-COVID average for this time of year. Finally, on to the GDP nowcast. So the Dallas Fed actually raised its GDP forecast for how the US economy is doing right now from 2.2% last week to 2.4%. But the Atlanta Fed, its Q2 GDP growth estimate fell quite sharply during the week. And actually, middle of the week, it fell below 2%, but it has since recovered. It all depends on obviously what data gets published. But the general picture from the Atlanta Fed is that GDP growth in the US is still strong, but it is weakening. The New York Fed's nowcast concurs. So its latest estimate is 1.8%, down from 2% last week. The Citigroup Economic Supplies Index remains mildly negative. And when you look at broad range of economic surprise indices, they are all negative. The US economy is surprising to the downside. Indeed, job postings, the broad trend is negative, but the index rose last week. And trueflation, we went into June, trueflation dropped sharply towards the 2% target. Trueflation is not seasonally adjusted, and most US inflation occurs at the start of the year. So the US is the richest country in the world, but inequality is a big problem, and you can see that in the life expectancy statistics. So the left-hand chart is life expectancy and is now below China, which is pretty shocking. And the deaths per 100,000 for middle-aged people is vastly higher than in other Western countries. And unlike them, the trend is not coming down. And one thing we've talked about many times, the US budget deficit is just totally out of control. And interest payments on the federal debt are forecast to just keep on rising unless the US starts to do something about it. Now, right now, they don't care. When you look at when you look at surveys of US consumers and what they are worried about, the budget deficit is just not there. That needs to change. Okay, US summary. So we had the JOLT job opening data, and that showed a US jobs market that is still tight but is gradually weakening. If job openings continue to fall at the current rate, then unemployment should start to pick up later in the year. PCE inflation for April came in on expectations at 2%, 2.7% for headline, 2.8% for core. Still too high. Lots of contradictory data now. ISM manufacturing PMIs were unexpectedly weak, but factory orders seem to remain strong. Service PMIs were unexpectedly strong, but then the Chicago PMI fell sharply. Consumers are feeling less confident, but the latest real-time estimates for US GDP growth remain pretty strong. And on to China. So this week we had the Caixin private sector PMIs. The manufacturing PMI was better at 51.7. Reminder, last week reported the official National Bureau of Statistics manufacturing PMI, and that fell to 49.5. So very confusing data coming out of China. Services PMI, again, the Caixin optimistic, showed it rising sharply to 54, much better than expectations and much better than April. And therefore, the composite rose to 54.1, much better than expectations, and frankly, much better than the NBS composite. So, who knows? Okay, errors and corrections. So last week, in the good news section, we were talking about the Danish gem collector, Itai Gudel, who has returned off his own bat 360 stolen items to the British Museum. Total hero. But in doing so, we stated that George Osborne had been chairman throughout the period of the thefts, which was not true. So he was first appointed chair in 2021, and he claims to have been responsible for helping the museum to take the theft seriously, and he remains in his post. So you can blame George Osborne for many things, but this particular debacle was not his fault. I still hold him responsible for the disastrous changes in UK property stamp duty, which mean that nobody moves house in the UK anymore if they can possibly help it. Thank you. But anyway, thank you to viewer PHS for getting in touch and correcting us. Okay, on to one chart. Now, AI is the next big thing, and we are expecting it to disrupt lots of services. And one of those could well be financial analysts. So what they've done is they've fed in the financial results of lots of US companies into ChatGPT and asked it to forecast future earnings. And it does that very well. It does that better than traditional analysts. And the AI was only fed financial metrics. It was not fed things like speeches by the CEO changes the economic backdrop, etc., etc. Its forecasts were 8% more accurate than analysts. So expect some job losses from financial analysts. But I thought this was also interesting. So this is the expected cost of training ChatGPT models by the AI generation. And you can see the rising costs is more than exponential. And the commentary is that means that AI models will become increasingly the domain of the tech giants. I have to say, I'm deeply skeptical that it will cost that much. Okay, now last week we did a piece on demographics, and one of my viewers, Magnets, got in touch and sent me a video, and I'm going to revisit it. So, although the birth rate is declining and has peaked, the world population will keep on growing, and it's forecast to hit 10 to 11 billion by 2100. And that's pretty much a 50% rise from where we are now. So there are going to be a lot more people on the planet. But the birth rate peaked in 2014. We're already past the number of peak births. So the reason that the population will keep rising is that the people who have been born are going to live longer. And the birth rate has peaked and is still falling and is expected to keep on falling. However, the projections for total world population are subject to significant uncertainty. So the mean forecast is that global population will peak towards the end of this century at around 11 billion, but there's significant uncertainty on either side. And these are the birth rates by country, and you can see that everywhere they are coming down, even in sub-Saharan Africa and Islamic countries. So I showed you this table last week, but I've been thinking about it, and what it implies is really extraordinary. So if you look at South Korea, which is the line at the top, the fertility rate per woman is now 0.8 children. So what that implies is if you start off with 100 parents, the next generation, there will be 39 children surviving to adulthood. So in one generation, you'll see a 60% drop in that cohort, population cohort. And if the birth rate remained unchanged, the 100 parents would have only 15 grandchildren. So the population cohorts by generation would go 100, 39, 15, 6. So if a generation is 25 years, in 75 years, the number of fertile adults would go from 100 to 6. You are seeing just total societal collapse happening in South Korea. China's not much better. We are going to see huge changes in demographics in our lifetime. Watch this space. Okay, on to OPEC Plus. So OPEC Plus met last weekend, and they have published monthly production targets for their members. Now, If you're interested, pause and take a look. I have turned those numbers into a chart. These are the production guidelines for all the OPEC members, and that the net increase over the period September 24 to September 25, the increase is 2.46 million barrels. And that's as implied by this table. And that's assuming that OPEC members keep to their quotas. So previously they said it was 2.2 million barrels. Actually, it's worse than that. It's 2.46. And the quotas go up in a linear fashion. So these are numbers I've calculated from that table. So starting from September, OPEC Plus will begin increasing production by 2.46 million barrels a day over the following year. And that is in addition to any baseline revisions, which they're currently debating. Now, we talked about this last week, but the last time baseline productions were agreed within OPEC was in 2018, and various members have had increased production capacity, such as the UAE and Iraq, and they are lobbying for the baselines to be revised. We expect the net rise in allowances of around 600,000 barrels a day when that work is complete, when the baseline revisions are complete and agreed, and with the UAE and Iraq leading the output rises. So the bottom line is OPEC are going to be opening the taps, and there's a lot more oil coming onto the market in the coming year, according to current plans, which can change. Now, I was going to do something on the gold standard, but actually I'd like Richard here. So we are going to do that in 2 weeks' time. And on to US corporate profits. Now, this is quite an important section. So last week, I showed you this chart, which showed that total US corporate profits in Q1 fell by 1.7%, massively below expectations. And that equates to a fall of 48.7 billion in aggregate corporate profits in the US, which is down 1.7%. Now, last week, I asked people to get in touch if they had data for aggregate S&P 500 earnings, because the only data I've got is earnings per share. And obviously, share buybacks mean that the share count is falling. So the rise in earnings per share in the S&P 500 in Q1 does not necessarily mean aggregate earnings rose. Now, thank you to Mr. C. Peckham, who got in touch, and he pointed out that you can back out aggregate earnings if you have market cap and the PE ratio. And he provided both. So I've done the calculation, and the net result is aggregate earnings for the S&P 500 actually fell slightly in Q1. So at the end of Q1, the PE ratio, the S&P 500, was 27.54. That was up on Q4. And so using the market cap numbers, you can back out aggregate earnings, and they fell. So the rise in earnings per share was due to a falling share count. So last week we were discussing how fall in aggregate corporate profits in the US meant that because S&P 500 earnings had risen in Q1, that the mass of companies outside the S&P 500 must have experienced a very sharp drop in their profitability in Q1. So we can now calculate what that drop was. So S&P 500 aggregate earnings were 1.6 trillion. Total US corporate earnings, as provided by the St. Louis Fed, were 2.75 trillion. So what that means is there was an aggregate drop in corporate profits for companies outside the S&P 500 of 30 billion. That's 2.9%. So quite substantial. So the picture is becoming quite consistent. So we now know that in Q1, corporate profits fell, and so US corporations are cutting back on their hiring. And that adds to a picture of the US economy, which is doing okay, but is slowing. So bottom line, in Q1, US corporate profits fell, particularly for the mass of small and medium-sized companies outside the S&P 500. Thank you to Mr. C. Peckham for his input on that. Okay, and also talking about last week, and I was talking about QE, and I talked about how the Bank of England accounts for the profits and losses of QE in a way that is unlike the Fed. So the Fed has created a massive dummy negative asset that it will write off slowly against seignorage profits, whereas the Bank of England has to have its losses paid for directly from the Treasury. So in the US, QE losses are not being accounted for in the fiscal deficit. In the UK, they are. Now, first of all, what is seignorage? Well, seignorage is the profits made by the central bank on the notes and coins it issues. So when it issues a banknote, whoever receives that banknote has to buy it off the central bank. And so the banknote doesn't give you any interest, but the money the central bank receives in return for those notes, it receives interest on, and that is seignorage. The reason that the Fed can create a negative asset and then write it off against seignorage profits is because it retains seignorage profits. The reason that the Bank of England can't is that the Treasury has already raided the Bank of England for the seignorage profits. The Bank of England already pays out its seignorage profits to the Treasury, and those amount to around 4 billion a year. So the Bank of England therefore has no stable sources of income and can't create a negative asset which to write off over time, because there's nothing, it has no income to allow it to write down that negative asset. So hence its QE losses are being paid for directly from the Treasury. Now, as Mr. C. Peckham, who got in touch about this issue, points out, QE losses are not just an accounting issue. Those losses are real and constitute a transfer of wealth from the Bank of England to the private sector, to asset holders, basically, bondholders. And those losses should be accounted for from the government budget because they're transfer from the government sector to the private sector. Bottom line is QE was a very bad policy and one which will be difficult to escape from. It was always anticipated that QE would cause capital losses to the Bank of England on the bond portfolio because the aim was to lower long-term interest rates and therefore stimulate investment demand. And if they were successful, that would lead to more demand for money, higher interest rates, and those higher interest rates would cause capital losses on the bond portfolio. And I remember that being discussed explicitly when QE was launched. But no one really complained about that when the losses were theoretical in the future, and the near-term effect of QE was rising asset prices and profits for everyone. Well, now we're in the period where those losses are being crystallized, and the net effect of QE was simply to shift interest expense from then to now. So previously, at the start of QE, you were getting lowest interest costs. Now we're having to pay that all back. And QE, the effect of QE was to lift asset prices everywhere. And for assets such as houses, they show strong negative price inelasticity, i.e., you push house prices up, but then homeowners see that their house is worth, 1.4 million for a dilapidated Victorian terraced house, 3-bedroom in East Finchley. And then when the estate agent comes round and says, well, I think it's only worth 1.1 million, they refuse to move and they wait for prices to go back up. So house prices show negative price inelasticity, leading to permanently higher prices. It's just a bad policy. And onto inflation watch. So the ECB met this week and they cut rates from 4.5% to 4.25%. They next meet on the 18th of July. The only inflation numbers we had were from the EU, and they showed inflation rising again in the EU up to 2.6% in May for headline, 2.9% core. So this chart shows inflation in 50 developed and emerging markets of a period from 2019 after inflation hit 8%. The red line is US, the black line is the Eurozone, and you'll see that inflation in the US and the Eurozone has come down much faster than in other countries. So inflation, as I correctly predicted, would come down very quickly. It's a pity the rest of my predictions have not turned out that way. And I keep on seeing this chart. This is in the red line, inflation now. In the green line is inflation in the 70s. And lots of people out there expecting a second wave of inflation. Unless we get another pandemic, I cannot see that happening. There's no evidence for that. But because of lag effects and the feedback loop, so workers demanding higher wages to compensate them for historic inflation, which in turn leads through to higher inflation in the coming period, you get this slowly decaying feedback loop after an inflationary shock. And that means inflation does take time to get back to normal. And these are 3 models from the Cleveland Fed. And they're expecting, according to 2 of their models at least, that inflation will come down, but it will take time. One thing that is still rising is shipping rates. And when we talk about supply shocks, the one we are having this year is container shipping rates due to disruptions in the Red Sea, causing much lower traffic through the Suez Canal. And as I discussed last week, retailers are now starting to book transport for the Christmas period, leading to rising rates, and that will feed through to higher inflation. Not much higher inflation, but higher inflation in the coming quarters. Now, earlier we talked about EU inflation, how service inflation was elevated. Well, there's a very strong correlation between service inflation and wage inflation with a 6-month lag. And because wage inflation has been falling, service inflation should follow it down further in the coming months. So bottom line is that historically, the seasonal patterns for inflation everywhere in the developed world are strong inflation in the first half of the year, then fading in the second half. And as we enter the second half of the year, I'm expecting inflation to come down. On to recession watch. So this is expenditure in the US. Although overall its expenditure, and that's the blue line, appears to be rising, a lot of that is non-market spending. So, for example, the fees that the US banking industry charges its customers, and therefore which is an expenditure by US consumers, is calculated from the Fed funds rate minus the bank rate, so the rate at which the interest rate that banks offer their customers. And that has been rising because US banks have not been passing on in full the increase in US interest rates. So imputed US consumer spending has been rising in large part because of these imputed non-market expenditures. If you look at market expenditures, and that is the red line, ex-food and energy, they have been falling. So US consumers do appear to be pulling in their horns. One thing that is an enduring mystery is the US housing market. So US new home supply has risen to its highest level since the financial crisis. At a time, existing home sales have been falling. Remind the scale's inverted. And I mean, the point of this chart is that as home sales fall, you'd expect rises in the unemployment rate, which just hasn't happened so far. But given that you're getting rising housing inventory, falling home sales, surely house prices should be falling and construction activity should be falling. So far, falling construction activity is minimal and construction employment continues to rise. Mystifying. Now, this is new commercial construction starts in the US, and they have been falling very sharply. So if all these projects start to be completed, then finally you might start to see, well, you should start to see construction employment in the US start to fall and the start of a traditional recession cycle. But so far, we've been waiting that for 18 months and it hasn't happened. Now, the falling JOLTS job openings number is reflected in surveys asking US consumers whether they thought jobs were plentiful or not. And few of them think that jobs are plentiful. And that is well below pre-pandemic levels. Now, small business hiring plans are in red. Will the unemployment rate now start to pick up? Reminder, I'm expecting it to start to pick up late Q3, Q4 on current trends if the job openings continue to fall in line with last few months. And last year, we got all excited by the failure of Silicon Valley Bank, but that did not lead through to a wider financial crisis in the US, but the number of problem banks is ticking up again. As we discussed last week, a lot of problem commercial real estate loans which need to be refinanced and losses crystallized. Returning once again to the mystery of how much excess pandemic savings remain, well, Barclays think there's a lot left. They think there's 850 billion and it's only being drained at 50 billion a month. So that would mean that US consumers have excess savings which they can use to fund consumption for at least another year. But the distribution matters. And as we talked about last week, there's a lot of signs of distress amongst the lower income brackets in the US. So poorer US citizens have absolutely run out of savings. Credit markets, though, remain utterly relaxed about credit quality, and the high yield credit spreads are low, so they're not concerned about defaults. Now, this afternoon, we get non-farm payrolls. Will they finally start to show fall in hiring? Fewer jobs created? Wait and see. So there is more data. So more and more data is showing that the US economy is starting to slow. On to soft landing watch. Well, if we look at the world as a whole, then JP Morgan thinks actually it's doing better than it has been for a while. It's growing again. And Andreas Steno Larsen thinks there is seasonality to economic surprises, and that we're entering a period in which the summer months show strong economic surprises, which would be good for equities. We showed you earlier that light vehicle sales in the US are holding up very well. Well, heavy truck sales, and by that we mean any heavy vehicle like diggers or bulldozers, and those are holding up remarkably well. So investment in durable goods and heavy-duty vehicles holding up very well. The Credit Managers Index shows clear signs of bottoming. So credit managers are starting to loosen their purse strings, but credit growth remains weak. Next time, I will report on the credit impulse in the US. I'll recalculate the numbers. Bottom line is the global economy appears to be doing just fine for now. And the US economy is also doing just fine, although it is showing signs of slowing. Good news. Well, this is a European bison, and they are spreading throughout Europe. So a small herd has just been released in Portugal in the Greater Coa Valley, which also has a small wolf population. So bisons, having been hunted to extinction throughout large areas of Europe, are now being reintroduced, which is great news. And their numbers are growing throughout the continent, particularly in Eastern Europe, and so Bulgaria and Poland. There's even a herd in Kent. And second item of good news. Well, last night, the USA beat Pakistan in a huge upset in the T20 World Cup after drawing after 20 overs, and they had a super over, and it was an absolute thriller. So after a century in which cricket has been doing nothing in the US, hopefully that will spark a revival. It's absolutely great for the game, and I urge you to watch the highlights. Really good. And on to equities. So decent week for global equity markets. The All World Index up 1.9%. The All Share up 0.5%. Stocks up 1.5%. Most, and I think that's a new high for the year. S&P 500, definitely a new high for the year, up 2.3%. So signs of weakness in the US economy are feeding through to falling interest rate expectations, and the equity market likes that. So currently, bad news is good news. The NASDAQ had a great week, up 2.6%, up 14.4%, and absolutely a new high. But the broad mass of stocks in the US, as measured by the Russell 2000, had a poor week, down 0.4%, up only 1.1% on the year. And as you discussed earlier, corporate earnings fell in Q1 and are not doing well. You would expect that to feed through to falling equity prices. Elsewhere, the Hang Seng was up a bit on the week, up 7.8% on the year. That huge surge we saw in April and May now appears to be over. Topics has had a great year so far, but has its big surge also come to an end? Bitcoin, well, it's going great guns, up another 4.3% last week, up 67% on the year. Amazing. Sterling, decent week, up 0.6%, up that on the year. The euro also up 0.6% because the dollar index fell. Indications of a slowing US economy led to rising rate cut expectations, and they weakened the dollar. VIX, dead as a dodo. Really, the options market is not expecting any equity volatility. So charts relating to equities. Well, this is weekly equity flows in the US, remaining strong, and it's all going into tech. So basically, US investors are selling every other sector apart from technology and industrials, and they're mainly putting into equities, and they're mainly putting into technology. 80% of net equity inflows have been into technology this year. And so is it any surprise that technology stocks have been going through the roof compared to all the other sectors? Part of the Conference Board surveys are they ask consumers whether they think the stock market will rise or fall in the coming year. And a near record number of them think the stock market will rise. I find this chart really interesting because the previous, when you look back to the dot-com bubble, current levels are higher even than then. Amazing. And it's very strongly pro-cyclical. So after the dot-com crash, everyone got pessimistic. When the market does well, everyone becomes optimistic. A warning, beware. Meanwhile, US hedge funds are selling industrials. So do they think that the weakening economy is going to lead through to weaker earnings for industrial companies? And market breadth is deteriorating. Never a good sign. So the market is being driven higher by fewer and fewer stocks. The Mag 7, therefore, as a proportion of the S&P 500, just keeps on growing. And the Mag 5 are responsible for the majority of returns for the whole index. So if you just invested in the top 5, you'd have made 27% this year. The remaining 495 companies have made 6%. And Nvidia now has a market cap higher than all the companies listed on the German stock exchange. Now, last week, I showed you a graphic which stated that 100% of analysts had a buy recommendation out on Nvidia. Well, Discord member Simon W sent me this, and that chart was just not true. It is true that nobody's got an underperform or sell notification out on them, but 42 have buys, 10 have outperformed, 4 have holds, and 12 have no opinion, which seems a bit of a cop-out. if you're going to look at one chart from this section, this should be it. Now, although the NASDAQ hit a record high, fewer stocks reached 52-week highs than hit 52-week lows. So more stocks are falling than rising. And that is quite a rare occurrence. So it shows a big divergence in the performance of stocks on the exchange. And when that has occurred previously, that tends to mark a peak in the market. So the red dots show you when those have occurred previously. Be afraid, be very afraid. And the market's just been marching relentlessly higher with it's 322 days since the last 2% down day. Extraordinary. And the number of indicators showing the market is overextended just keeps on growing. And the market's expensive. PE ratio 24.3. So the previous peaks in the pandemic and post GFC were because the economy went into recession and earnings absolutely collapsed. The only previous time that the P ratios were this elevated were pre-GFC, were during .com. And I personally find the current situation increasingly analogous to .com. On to commodities. And there have been strong inflows into commodities in the last few months. April saw a huge inflow, which is remarkably bad timing because although commodities, metals surged in April, they're coming back down in May. So, quick summary. Energy complex showed broad weakness after OPEC announced that they were going to increase production starting in September. Industrial metals also showed broad weakness, particularly iron, tin, and nickel. So having had a very strong couple of months, that is now unwinding. Precious metals, gold and silver rose again. PGMs fell. On to the energy market. So Brent had a bad week, although it has bounced over the last couple of days, but it ended down 2.3% on the week, now up only 4% on the year. WTI showed a similar pattern. Numbers specific to the oil market, and for the third week in a row, we have had big builds in the US. So last week, we saw an absolutely enormous 14.3 million barrel build. Big numbers. US market oversupplied. US crude production output remained stable at 13.1 million barrels a day. Reminder, the EIA is expecting US oil production growth to resume in H2. The Baker Hughes rig count, though, ticked down one and is down on the year. So the red line is global oil inventories. And contrary to whatever else you might hear, they are not low and they're not coming down. And stepping back, this is forecasts for oil production and demand back in 1977. And so they were then expecting demand to start outstripping supply by the late 90s. And they were wrong. Never underestimate human ingenuity. We've found lots more oil and developed the shale plays, which is all due to technology. If we start to run out of hydrocarbons, there are plenty of hydrocarbons in the world. As we've previously discussed, if you were to start exploiting the methyl hydrates trapped on the ocean floor and start burning those, you would burn up all the oxygen in the atmosphere. Not something we wish to contemplate. Natural gas futures, good news for Europe. They seem to have hit a near-term peak, closing down 5% on the week, up only 2% year to date. UK natural gas futures also came down on the year. US natural gas rising again. When you look at the shale gas basins, Appalachia appears to have peaked. The Haynesville appears to have peaked. The Eagle Ford is doing nothing. The only basin that is still growing is the Permian. So at current gas prices, on current trends, it would appear that we're approaching a peak in US gas production. The end of gas production growth is coming into sight. Coal prices had a terrible week, down 5%, down 6.5% on the year. Uranium drifting off, now down 2.9% on the week and 4.1% on the year. Uranium equities and ETFs such as Yellowcake fell much more. So although there was only a small fall in the underlying uranium price, the ETFs fell more sharply. So it looks like private investors are giving up on the uranium bull story and selling, leading to rising discounts on the ETFs. Onto industrial metals. So aluminium, having had a great run, that appears to have peaked. It was down 2.7% last week, down 10%, so up 10% on the year. Cobalt going nowhere. Copper, again, seems to have hit a near-term peak, down 0.4% on the week, still up 20% year to date. And we talked previously about how Chinese copper inventories were rising, which remains the case. But when you look at global copper inventories, they're not actually too high. So the darkish brown segment is the Shanghai Futures Exchange inventories, and that has absolutely been growing. But overall, inventories around the world have certainly risen, but they're much lower than they used to be in the pre-pandemic period. So this is Wood Mac's forecast for the surplus/deficit in the copper market. We are in 2024. They're forecasting a 300,000 ton deficit, which will actually improve next year before worsening again. So Wood Mac are forecasting that the copper market will remain in deficit in the coming years. That is good for the copper price. Chromium flat, down on the year. Iron ore had a shocker, down almost 8%, down 24% year to date. So is that evidence that China is not doing so great? Lithium drifting off again, down 3.8% on the week and now up only 5% year to date. The big bull market in lithium post-pandemic has well and truly come to an end. Neodymium also drifting off again. Nickel, having had a huge spike, that is unwinding. Reminder, Indonesia is due to produce vast amounts of nickel, leading to a nickel surplus for the next 3 years. So the rise in the nickel price was always rather puzzling. Tin also coming off and coming off sharply, though it is still up 22% on the year. Ferrovanadium, dead as a dodo. Zinc, following a similar pattern to other industrial metals, coming off, but still up 10% on the year. Onto precious metals, Well, having had a small correction, gold rose on the week, up 1.3%, up almost 16% year to date. Now, when you look at the gold price relative to the S&P 500, and this is just the price level, it does not include dividends. Well, gold has kept pace with the S&P 500 over the last 6 years. And relative, and since .com, gold has been a much better investment than the S&P 500. And the recent surge in the gold price has been due to China. So the white line is their whole reserves in gold. The red line is treasuries. They are cutting their holdings of US treasuries and buying more gold. Silver actually unchanged on the week, but up 29% year to date. But the PGM group weak. So platinum drifting off again, down 1.9% on the week. Rhodium, dead as a dodo, down 0.5%. Palladium, having had that big spike at the end of 2023, that's fully unwound. It's now down 24% year to date. Finally, on to rates. UK yield curve. We had a good week, but that brings the UK yield curve just back to where it was a month ago. The US yield curve has actually shifted down quite substantially over the last month. Now, this is the bid to cover ratio in US Treasury auctions, and it's poor. So we know that the US Treasury is issuing vast amounts of new bonds and bills, actually mainly bills, to fund the ludicrous deficit. Well, this is signs that the market is suffering from indigestion. And those poor auctions are not a good sign when there's 9.3 trillion of existing US treasuries which need to be refinanced this year. And that will be on top of the 1.7 trillion of new debt it needs to issue. There's a lot of bonds. There's an avalanche of bonds coming this year and in future years, unless the US starts to cut the deficit. But the rise in bond yields over the last couple of years has not really been due to rising inflation expectations. It's been due to real yields. Okay, this is the UK 2-year, down the last week, but still up on the year. 10-year, big rise since the start of the year, 4.2%. The 30-year, 4.7%. Better, still not good. US 10-year, which has come down quite sharply from recent peaks, doing much better than the UK, actually. German 10-year, the bond market is actually concerned about the German economy, leading to rising German bond yields. If you compare that with the Italian, German bond yields have risen much more than Italian bond yields. So no sign of the Eurozone crisis. In fact, rather the opposite. Most of the Greek bonds are held by institutions. So, this is not really very representative or relevant. Concluding comments. So this week we had the ECB and the Bank of Canada cutting rates. The ECB raised its growth and inflation forecasts. So although it's cut rates, and frankly, it got itself into a bit of a corner given the number of speeches that ECB board members gave saying that they intended to cut rates, it seemed it had no choice. But the rate at which it continues to cut from here will depend on inflation. Now, we expect Eurozone inflation to come down more quickly in the second half following wages which are coming down. We had the JOLTS data, we had the JOLTS job opening data in the US, which confirm that the US labor market is slowing. Now, according to the beverage curve. If that continues, and we expect it to do so, then the unemployment rate should start to pick up in the latter half of the year, not during the summer, but towards the end of Q3, early Q4. Non-farm payrolls are out later today. Richard is unfortunately away. I'm sailing this week, so you've just got me. And I had a better week, although obviously my year is still shit as I've got this wrong. And I was up 4% on the week, but I'm still down 8.2% year to date. So not looking very clever, frankly, particularly when equity markets are going great guns. But I think things are going to start going my way in the second half, frankly. So indications are that the economy is starting to slow in the US, and UK yields are just following the US. They don't seem to be doing anything much on their own. When the day-to-day movements in UK bond yields are entirely predicated on movements in the US bond yields. So if the US starts to slow, then you should see interest rate expectations start to fall. And that will be good for me. In addition, I increasingly think that the equity market is very analogous to .com. Nvidia has had amazing earnings and revenue growth, but when its market cap surpasses 3 trillion, making it, if not the most valuable company in the world, then one of the most valuable companies in the world, and it remains on a P ratio, a forward P ratio of 46 when its revenue growth is due to start falling, I think that is too much. Now, I've been saying that for a long time and I've been totally wrong, but it seems that the market in tech is very frothy, and we've been here before. Now, during .com, which I remember vividly, I decided that equity market valuations were just ludicrously too high in 1996, and I got out of the market. And I then spent 3 years looking extremely foolish as the equity market went through the roof. But I didn't buy. I just waited until it crashed, and then I bought in. Frankly, I'm going to be doing the same this time. So, right now I'm looking a bit of an idiot, but I'm actually feeling much better about things than I was 6 months, a year ago. So not looking very clever, but sticking with it. Okay, so I hope you're doing much better than me. Not difficult. Richard's away this week, but in 2 weeks' time, when I get back from Croatia, he will be back. So normal service will resume. In the meantime, please can you press like and subscribe to the channel, and thank you very much for watching, and it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.